Bitcoin is stuck in the 70s, staying alive. Staying alive. And the biggest story on mainstream media is Iran called. And Trump picked up.
Hello?
The war might be over. Hormuz might reopen. My gas prices might come down. But here's what they're not telling you. Why the war ended. The war ended because America can't afford it anymore. They're pretending they can, but 10-year treasury yields moved 42 basis points the week the strike started. On $36 trillion of debt. Do that math in your head. And while the ceasefire was being negotiated, India paid Iran in yuan to move an oil tanker through the Strait of Hormuz. Not dollars, yuan. The bypass lane for dollar-free oil trade just got built. So which one is going parabolic first? Bitcoin or gas? I'm Oceans. This is Beyond Bitcoin. Let's go. But not too far, because I don't think we can afford it. Bitcoin is holding in the 70s as of this recording, and the narrative machine is fully in peace deal mode. Trump announced a deal. Iran came to the table. The Strait of Hormuz is reopening, and the financial press is doing what it has always done, covering the event, not the structure underneath the event. Today we're going deeper than the headline, because the Iran ceasefire reveals 3 structural failures of fiat money that Bitcoin was built to survive, and they don't go away when Hormuz opens. First problem, the war they can't stop borrowing to fund. 42 basis points on $36 trillion in debt is roughly $413 million a day in extra interest. Every day. Wait. That's an interest alone? And I have to pay for a war on top of that? Oh, wow. Okay. Do you have like a lower tier war subscription? You know, like a hobbyist level? Something around $19 a month? Much more my budget. Second problem, dollar weaponization that backfires. While Trump was issuing ultimatums, India quietly paid Iran's Strait of Hormuz toll in yuan. By the way, the word quietly is the #1 indicator that AI wrote your script. Nations paying for oil in yuan get safe passage. The petro-yuan infrastructure got built during the war to defend the petrodollar, which is weird. That's the part that nobody's covering. And third, a quickly moving collapse of purchasing power. Gas prices that seem to fluctuate with the change of weather. Bitcoin dropped 2.5% through all of it, and the S&P 500 hit 2026 lows, which I know we're still in March, so it doesn't mean much, but 240,000 traders got liquidated. Morgan Stanley, however, just filed for its own spot Bitcoin ETF. That's the first major US bank in history. The institutions aren't trading the war. They're pricing the fiscal reality the war just made impossible to ignore. Bitcoin is the answer to all 3 of these problems. Let's start with the math, our new superhero of this era, because math is what stopped this war. Not diplomacy, not strategy, formerly MicroStrategy, math. The US has $36 trillion in debt. That number is not abstract. That number has a monthly payment. And when you go to war in a region that controls 20% of global oil supply, and the bond markets decide it doesn't like that, the interest rate on your debt goes up. In the week the Iran strike started, the 10-year treasury yield moved 42 basis points, from roughly 3.97% to 4.39% in 1 week. Now, 42 basis points on $36 trillion, that's approximately $413 million in extra interest per day. Not total, extra. Above what the government was already paying before the war started. And it wasn't just the bond market. Oil went to $90 a barrel. Airlines were pricing in $175 crude scenario. U.S. farmers, Trump's most loyal constituency, were getting crushed before planting season. And fertilizer prices were up. Diesel prices were up. Margins gone. Trump literally predicted oil would go higher. How could he have known that? Perhaps he can read the future? There's a great series of quotes circulating this week where Trump says at one point, I think we've won. 3 hours later, we were winding down. 1 hour after that, he doesn't want a ceasefire. And then a deal happened. That's 5-dimensional chess at play if I've ever seen it. That's a president who has 2 audiences, the domestic base and the bond market. And only one of them got what it wanted. Well done, Trump. So who won? Bond market. James Bond market. And here's the part that should really bother you. This was Iran, a regional power, a country with its air defenses reportedly degraded in the first week, a country with half its oil revenue already sanctioned, and the bond market still pooped its pants. What happens the next time? What happens when it's a bigger country, a bigger war, a longer poop? The answer is you can't afford it. Not because the military isn't powerful enough. Well, no, it's because the military isn't powerful enough because you can't pay them because the interest on your debt means that you have to print more, which devalues the units you're printing for your military to operate in the first place.
So tomorrow morning sometime, their time, we were expected to blow up their largest electric generating plants that cost over $10 billion to build. It's a very good one. There was no dearth of money. And one shot, it's gone. It collapses. Why would they want that? So they called. I didn't call. They called. They want to make a deal. And we are very willing to make a deal. It's got to be a good deal. And it's got to be no more wars, no more nuclear weapons. They're not going to have nuclear weapons anymore. They're agreeing to that. Any of that stuff, there's no deal.
They called it. I didn't. Regardless of the truth in that statement, it's always funny to hear Trump's boss language, right? I would never call. Only losers call. Losers. Anyway, that was the closing line of the negotiation. And to be fair, it's a good line. It's also the only acceptable framing in the current political environment. Nobody in Washington can say the bond market ended the war. That's not a press release that goes out. But the oil price analyst at Bloomberg said it. The Farm Bureau said it. The interest rate math says it. The only people not saying it are the ones whose job it is to maintain the narrative that American military power is unconditional. It isn't. It has a price. And this is where it gets interesting. Right now, the price is $413 million a day in extra interest. I told you it gets interesting. Isn't it great that Bitcoin lives outside of that system?
Either let inflation run hot or let the sovereign bond market potentially default and run into liquidity problems. That's really their two main choices. Like I mentioned, the third choice, which only works temporarily, is they could ease regulations on banks so they don't have to count treasuries and cash against their capital, which basically allows banks to lever up and buy more treasuries or perform more repo lending. So they have a handful of levers they can pull that either look like QE or shadow QE. But at the end of the day, they never let the bond market just go illiquid. And so they always err on more inflation, even when it's above target.
You see where this is going, right? The United States government has two options. Option A, let inflation run hot, which means the dollar in your pocket is worth less every year and the real cost of debt gets inflated away. Option B, let the bond market break, which means liquidity crisis, potential default, financial system stress. Those are your two options. That's the menu. Can I get onions on the side of that, please? There is no option C where they cut spending, pay down the debt, run a surplus, and stabilize the currency. That option requires a political consensus that doesn't exist and probably can't exist with this much debt outstanding. Every war they fight makes the options worse. Every dollar of deficit spending makes option A more likely. Every basis point of yield increase makes option B more likely. And sitting outside of both of those options is Bitcoin. Fixed supply, no central bank, no interest meter. You can have your onions on the side. The exit exists. Quick break for a second. And look, given what we're just talking about, today's sponsor is actually relevant. If you're paying attention to where the regulatory environment is headed for the Bitcoin mining industry and infrastructure, the people making those decisions are all going to be in the same room this summer at Mining Disrupt 2026 in Miami, July 21st through the 23rd. It's the world's largest Bitcoin mining expo, and it started as a Telegram chat between miners and insiders. Now it's the premier place where the entire industry converges. Operators, energy companies, hardware manufacturers, and people building Bitcoin's physical infrastructure are all going to be there. And now that Bitcoin mining is formally confirmed as a digital commodity, not a security, not under the SEC's thumb, the conversation is happening at that conference this summer, and it's going to be lit, my friend, lit. Use promo code SimplyBitcoin at miningdisrupt.com. You'll get 20% off your tickets. Genesis and Miner tiers are selling out first. Go to miningdisrupt.com. Go now. The tickets are selling out quick. Now, the ceasefire headlines buried the actual story. Let me give it to you here. India paid Iran's Strait of Hormuz transit fee for an oil tanker to pass through it in yuan. And here's the key sentence from the reporting this week. Nations paying for oil in yuan are granted safe passage through the Strait of Hormuz, a toll road for dollar-free oil trade, built while Trump was threatening to close Hormuz. Think about what actually happened here. The United States went to war, in part, to maintain dollar hegemony over global oil markets. That is the core logic of the petrodollar system that Nixon and Kissinger built in 1973. You price oil in dollars. The world needs dollars to buy oil. The world holds dollars in reserve. The dollar stays the world's reserve currency. The US can run deficits. The cycle continues and everyone is happy. But what if Iran during the war built the bypass lane and India used it? And it happened this week. That did happen this week. Yeah, what if it did? It did. Yeah, but what if? Then we would be where we are. What if we were where we are? Stop it. Stop it, please. Stop it. Just stop it. A tweet from Radar Hits that's been circulating says, Donald Trump has achieved the petro yuan and undermined U.S. hegemony through the petrodollar. That's a little spicy, but it's not wrong. The war to defend the petrodollar created the infrastructure for the petro yuan. That's the outcome. The peace deal reopens the Strait of Hormuz, yes, but it does not close the yuan toll road. It does not unbuild the settlement infrastructure. It does not make India go back to paying in dollars. The bypass exists. It worked. Countries noticed. Now, to be precise, the petro yuan is not being replaced by the petrodollar tomorrow, or next year, or probably in this decade. The dollar is still 70% of global foreign exchange reserves. The treasury market is still the deepest, most liquid debt market in the world. The plumbing of global trade still runs mostly through the SWIFT and dollar-denominated systems. Mostly. But here's what changed this week. Another data point that got added to the trend line. Saudi Arabia, Russia, China, India, the BRICS, all of them have been building alternative settlement infrastructure for years. Have you seen that one episode of Sanctions? The one where Russia gets sanctioned in 2022? Classic. Or how about the whole season where Iran gets sanctioned for decades? Man, I love that show. Every war that threatens the trade routes that run through dollar hegemony, accelerate it. Isn't that like an anti-fragile system? I guess, inversely, kind of. The pace is slow, but it's not reversing. The direction is set.
So shifting back to neutral reserve assets can be a painful transition, but I think it's a more natural state of affairs, and so I think a lot of these moves make a lot of sense.
So I mean, sovereigns are preparing for a world where the U.S. remains the core of the system, but the margin of safety is kind of no longer trusted to the same degree.
Yeah, I would describe it that it's moving to a world where the U.S. is the biggest individual entity in currency reserves, but it is not the only game in town. So right now, obviously the two biggest economic powers are the U.S. and China. China's got a much stronger industrial base. The U.S. has a much stronger kind of capital markets and global reserve base. But around the margins, there's been a shift, a tiny bit into Chinese bonds, but primarily into these neutral reserve assets like gold. So basically, you have gold as a major reserve asset. You have treasuries as a major reserve asset. Around the margins, you have other major developed fiats as reserve assets. And that's just in general, it's a more balanced system than basically having 80% of all assets stuffed into U.S. markets.
Here's the way I think about this. For 50 years, the petrodollar system worked because it served everyone. Oil exporters got stable dollar revenues, the U.S. got a permanent demand for its currency and its debt, and the world got a pricing mechanism for global energy that was liquid, predictable, and backed by the biggest military in human history. The military is still the biggest, but the debt is now $36 trillion. The rate on the debt is 4.39%. That's like an aircraft carrier every month. What happens when the cost of maintaining the system exceeds the benefit of being in that system? Well, you get India paying in yuan. You get countries quietly diversifying reserves. Quietly. You get gold at 4,500 an ounce, while the dollar slowly melts. That's the transition Lyn Alden just described. A shift of neutral reserve assets. That's what this week's oil tanker was about. One transaction, one data point, one more reason for every country outside of the dollar system to keep building the bypass. And sitting there as the only global neutral, non-sovereign, fixed supply asset in existence is, of course, Bitcoin. So I'm going to pause here for a second. If you've been watching this show and you're thinking, okay, I believe this thesis, but I don't actually have my Bitcoin in self-custody. Well, today is the day to fix that. Go to thebitcoinway.com/beyondbitcoin for a free 30-minute consultation. They don't try to upsell you. There's no pressure. These are actual Bitcoiners who will walk you through self-custody, cold storage, and everything that you need to know to not be dependent on an exchange when things get weird. The bypass lane for your own savings is right there at thebitcoinway.com/beyondbitcoin. Go there right now, book a free 30-minute consultation. Now let's talk about what actually happened this week in markets, because the narrative is Bitcoin sold off during the war, and that's true, minus 2.4%. But here's what else happened. The S&P 500 hit 2026 lows. Gold ETFs shed 30 tons in a week, erasing every gain from 2026. 240,000 traders got liquidated across crypto markets. The safe haven assets were not having a safe haven week. Now, during all this, Bitcoin lost 2.4%, which is like a normal Thursday for Bitcoin. And now I know what you're thinking. That's not exactly inspiring. And you're right that it's not the Bitcoin goes up when everything goes down thesis. But let's contextualize what we're talking about here. This was a geopolitical shock, a real shooting war in the Middle East, the biggest oil choke point in the world under threat. Treasury yields spiking, the S&P in a free fall, and Bitcoin held in the 70s. Let's talk about gold for a second, because gold is interesting again. Gold hit $4,000 an ounce earlier this year. It's been the trend of 2025 and 2026. Central banks are buying, retail is buying, everyone loves gold, especially Costco members. And then gold ETFs shed 30 tons this week. 30 tons gone in 1 week. Every 2026 gain wiped out. What does that tell you? It tells you that when institutional investors, pension funds, hedge funds, the folks managing other people's money need to raise cash in a stress event, they sell what's liquid. They sell what they can sell, and gold ETFs are liquid. Bitcoin is also liquid, and Bitcoin dropped 2.4%. Gold ETFs lost more than that in underlying NAV terms, while also suffering massive outflows. Now, I'm not here to argue that Bitcoin is a better short-term hedge than gold. Well, I literally am here for that. I mean, we're not called simply gold now, are we? Ha! But I'm also here to point out that the story, Bitcoin is just a risk asset that gets dumped in a crisis, is not what the data says this week. The Bitcoin options market is the most defensively positioned it's been since June 2021. VanEck's chain check report this week shows the put-call open interest ratio averaged 0.77, its highest in nearly 5 years. Put premiums elevated. Volatility skewed defensive. Everyone is hedged. I understand nothing. The last time the options market was this defensive, June 2021, Bitcoin was at $30,000. 6 months later, it was at $69,000. That's over double the price for all you math wizards. Now, we all know that past performance doesn't equal something. I know. But here's the question worth sitting with. Who is buying those puts? Who is that defensively positioned? It's not retail. Retail's fear and greed is in extreme fear right now, as of this recording, and not paying premium for downside protection. It's institutions. And the institutions don't pay for puts. They don't have corresponding long positions to protect. The options market right now is telling you someone has a lot of Bitcoin and they're paying to keep it. And then there's Morgan Stanley. Morgan Stanley just filed for a spot Bitcoin ETF, ticker MSBT. Fidelity as their custodian, BNY Mellon handling cash custody. Seed capital, $1 million. This is the first major US bank to file for its own spot Bitcoin ETF. Not a brokerage product, not third-party access, their own fund with their name on it. You know what Morgan Stanley is not? A Bitcoin maximalist. You know what Morgan Stanley is? A fiduciary institution that manages hundreds of billions of dollars in client assets and has spent the last 3 years watching BlackRock and Fidelity print money off Bitcoin ETF fees and eat their lunch. This is not ideological, this is competitive pressure. And competitive pressure from Morgan Stanley is a different signal than a VC fund tweeting about its digital gold. And then their strategy. Michael Saylor's company bought 89,000 Bitcoin in Q1 alone. $6.2 billion worth of Bitcoin in 1 quarter while everything else was selling off. While the war was happening, while yields were spiking, strategy just bought that war. 89,000 Bitcoin at a time when the fear and greed index was in extreme fear, at a time when 240,000 traders were getting liquidated, at a time when the macro environment was objectively terrifying. And Saylor's quote this week, in case you missed it, in 7 years, Bitcoin will crash from $1 million to $750,000, and people will say Bitcoin is dead then too. The man has no range.
Above target debasement, largely driven by that fiscal excess. And so it's more stagflationary rather than kind of the disinflation that we normally see during kind of weaker economic periods.
Yeah, and I mean, Lynn, when we talk about the bearish side of things, I always get in trouble because the bulls push me back on this, and they say, they argue that the wealth effect is real, that the top 10% own the bulk of the assets, and they continue to spend. I mean, even if manufacturing is weaker, they'd say that the strength and service keeps the U.S. out of recession. Does that argument carry weight?
To some extent, I mean that's why I'm not too bearish.
Here's the macro picture Lynn Alden is describing, and this is the thing that ties all three topics together. We're not in a normal cycle. We're not in a recession, Fed cuts, recovery, growth, repeat. That playbook assumes the central bank has room to cut rates, reflate the economy, and everything normalizes. It doesn't have that room anymore. When the Fed cuts rates now, it risks reaccelerating inflation that's still above target. When the Fed holds rates, it accelerates the debt servicing crisis on the $36 trillion. When the government spends to stimulate, it adds to that debt. When it cuts to reduce the debt, it risks recession. Every lever pulls in the wrong direction simultaneously. That's precisely what Lynn Alden means by stagflation. That's the above target debasement driven by fiscal excess. That's the environment where you don't just print your way to normal. The old options, cut, print, stimulate, they create new problems faster than they solve the old ones. And in that environment, what's the one asset that has a fixed supply, no central bank, no government lever, and no interest meter? You know the answer. You watch this show. I'm not going to insult you by saying it's Bitcoin, duh, because it's Bitcoin, duh. Let me land this one like the Fed in a macroeconomic crisis, softer than a cheese grater moving one cycle per quarter, whatever that means. The Iran ceasefire is real news. The Hormuz reopening is real news. Oil prices coming down is real news. And none of it changes the structural picture. 42 basis points, $413 million a day in extra interest. That's an aircraft carrier month, if I mention that. That's what ended the war, not strategy, math. Another clue, the dollar is dying. India in the Strait of Hormuz with the the yuan. The petro-yuan bypass infrastructure is operational. The peace deal doesn't close it. Morgan Stanley, 89,000 Bitcoin. Options market. Institutions are not trading the war. They are pricing the fiscal reality the war just made impossible to ignore. Bitcoin may not be up this week, but Bitcoin is up forever, Laura. Real quick before I sign off. ClubOrange, formerly known as the Orange Pill app. This is the premier app where Bitcoiners go to connect. In person, real humans with digital avatars. This is the app where they all come together in a Bitcoin community. And you can find me on there. I'm at Oshins, O-S-H-I-N-S. Tell me what you thought of today's show if you want. Tell me if you have been transacting yuan lately, if you're trying to get through the Strait of Hormuz. Whatever it is you want to tell me, I respond to all my messages. Shout out to Mo and Michael and Mana and Mash Mining and Mateo and Murdoch and Mark. May all your May be merry. ClubOrange.org, formerly known as the Orange Pill app. Go download it today. I'll see you there. Here's the thing that nobody wants to say out loud in the financial press. The United States went to war to defend the dollar's role in global oil markets, yes. The war lasted until the bond market made it too expensive. While it was happening, a country that is not aligned with the United States used the opportunity to run a yuan oil settlement transaction through a choke point America was trying to close. War to defend the dollar accelerated the dollar's decline. Oh, the irony. Man, when your money is backed by political power rather than fixed supply, every political decision affects its value. Every war, every deficit, every interest rate change, every sanctions regime. You are not outside that system. Your savings are inside of it. Your pension is inside of it. Your government is making decisions with it that you did not vote for and you cannot opt out of. Except you can buy Bitcoin. Not because Bitcoin fixes all of this, and it does. Not because Satoshi is going to swoop in and dissolve the Fed, and he will. Because while all of this is happening, there is an asset with a fixed supply, no central bank, no political lever, and no interest meter. It doesn't care about Hormuz. It doesn't care about the yuan. It doesn't care about the $36 trillion of debt. It just exists outside of all of it, waiting. Go study Bitcoin. Thank you so much for watching this video. If you like what you see and you want to see more, make sure you hit that like button below, or you can subscribe to the Simply Bitcoin channel for more content like this. We're coming out with it every single day of the week. Also, do not forget to hit that notification bell. You can just leave us a comment if you like. If you want to find me, I'm on X at RunDanceBitcoin. Otherwise, I'm Oshins. This is Beyond Bitcoin. Until next time.